looks like. Siphamandla, hello to you. This is where you're going to tell me, I'm sure you are, we're going to see a reduction of interest rates by 3% on Thursday, right? That's what you're going to tell us.
I wish I could say that. Good morning to you and your viewers. Look, I think consumers should be looking forward to the end of the hiking cycle. It does appear that inflation is tracking back, but it's still got a bit of a distance between where it is now and the desired target. What that means then is that at least the pace of the hiking cycle is probably going to slow going forward, or in the next meeting, we expect a 50 basis points increase in interest rates, which is lower than the 75 that we have seen in the last 3 meetings. And we do think that that is probably going to be the end, or the terminal rate, or the end of the hiking cycle by the South African Reserve Bank, and consumers should start looking forward to mild cuts towards the end of the year, as well as in the first quarter of 2024.
Help me understand, Siphamandla. Sorry, I clearly skipped these lectures at University Economics 101. Why is it that we're seeing inflation slowing down, just ever so marginally, but we're seeing interest rates potentially still going up? I thought the two walked hand in hand like an old married couple.
Yeah. Right. They should, theoretically. But Gareth, you should also take into consideration that there are lags. There is a time lag between when there is an interest rate decision and when it filters through into the economy. At the moment, risks are still tilted to the upside. We have seen, for instance, an electricity hike, which is still uncertain at the moment whether it will finally be implemented, of double digits. We are seeing globally that oil prices are starting to decline from elevated levels that we saw, especially at the beginning of 2021. Global food prices are also starting to slow, but there are still some risks in the system, including, the unfavorable global weather conditions, which could counteract the downward trend in global food prices, as well as spark some fears around food shortage. We've seen some countries imposing bans on export of some food items. So the risks are still tilted to the upside, and the Reserve Bank has said in the past that they want to see inflation, or at least inflation expectations, firmly anchored around the 4.5% target, which is still a bit of a distance from where we are currently.
So there's two aspects when it comes to interest rate hikes. Generally, it's seen in a fairly negative light, Siphamandla, because most of us, I'm not going to say all of us, but most of us are very bad at savings. We live on credit cards, we live in overdrafts. But if you're an investor right now, if you've got someone who's got maybe a big savings account that you want higher interest rates, this is a good week. So we're not going to talk about those who are lucky enough, who are more responsible than most of us, to put money away. What is an expected increase, like the one we're expecting on Thursday, going to mean, for example, for a home loan or a car repayment? Can you give me like a real breakdown of what that means? Say a R1 million home and a 500,000 Rand car. What would that look like, do you think?
Right. So first things first, what interest rate increases mean for South Africans, especially those that have bonds as well as car repayments, is that it's unlike in developed markets where some consumers, the majority of consumers there have the benefit of fixing interest rate at low levels. So when there are adjustments in those countries, it's only limited to those consumers that have a variable interest rate on their debt. In the South African case, it's actually the opposite. A majority of South Africans, when they take up this kind of debt, bonds or car repayments, about 98% of that debt is on variable interest rates. So changes in interest rates have immediate impact on consumers. So the expected increase in interest rates the expected increase in repayment that we expect with the interest rate change on Thursday should mean something around 250 or so in your bond more. But you also have to take into consideration that we have seen quite a drastic increase in interest rates in 2022. So it compounds the impact that we saw in 2021. So independent on its own, it isn't that much, but if you add all of this up,
Oh, Sepamandla, I hope I'm not losing you
does
right
take
at the
a
end. It looks
sizable
like I
chunk,
might have lost
in-
your Zoom. Your
in
picture
consumers'
has
pocket.
frozen as well. But Sepamandla, thank you very much indeed. Just getting in, I think, in time for that Zoom to fail on us about the cost of your home loan. About 250, 300 Rand extra for your home loan. And I'm guessing it's based on about R1 million. So you're going to have to work out the maths yourself as well. Also, not good news for those who may have just bought a new car or two. FNB economist Sepamandla Mkhwanazi. It's not great news. It's not as bad as it could have been for the expectation of MPC this coming Thursday, but we are all going to be paying a little bit more for our cars and our homes.